I think there's a useful focusing device, definitely, in the proposal for the new architecture. So I hope we can take that up through our two discussants as well. Stephany, would you like to go next?
Well, thank you
10
very
minutes,
much.
please.
I want to thank Dirk and ODI for inviting me to comment on what I consider as a really outstanding report. So although it's long, I encourage you to read it. I want to make some general comments, and then I want to focus on one particular aspect that Dirk and I are working with the European Commission on contingency financing in the face of shocks, which has, of course, become much more important as a result of the crisis. So my first point, I think, is that in looking at the impact of the crisis on LDCs, the report is right to say that the poorest countries have actually done quite well up to now. And I think they're also right, and this is something that Charles didn't mention, but is in the report, and I've done quite a lot of work on it. The international community has actually been rather positive in the response to the crisis, in the sense of helping developing countries maintain their growth momentum. And I would say that this is, on the whole, more true for emerging and middle-income countries than for the poorest countries. So we have a little bit, the poorest countries have been a little bit the Cinderellas, if you like, of the international system. They have been helped. There has been a counter-cyclical response from the World Bank, the IMF, and so on, and particularly the regional development banks, but it hasn't been enough. Now, I think that since this report was written, so things have actually got worse, unfortunately. We have the unfolding of the European crisis getting more and more serious by every day, and particularly from, I think, a developing country perspective, we have the fact that there are all these fiscal tightenings across Europe at a time when the private sector is very unwilling to spend, to invest, or to consume. And so I think there is a fear that there will be a new slowdown, a further acceleration of a slowdown of the recovery, so that the recovery could be weakened, and that will be highly problematic for developing countries in general and for the poorest in particular. And the other issue, which I think has to be a source of concern, is on the whole, developed countries have been quite good about maintaining levels of aid, and some even increasing it. In fact, this country, rather surprisingly, under conservative government, is actually continuing to increase aid in a context of massive cuts. But others are not. I mean, Spain, for example, just to give you one example, as a part of its massive budget cuts under pressure from the financial markets, has begun to cut aid quite substantively, and Spain had been a country that had been increasing aid quite significantly. So we have, I think, a new concern there, which is almost, evolving by the day. The second issue that I wanted to raise is that I like the fact that the report says, we can't continue with business as usual. And I think this is particularly true, actually, of the international and the developed country context, as well as of the LDC context. Because there's an American saying, if it ain't broke, you don't have to fix it. But the problem is that the international financial system is broke, and we do have to fix it in quite a radical way. So I think radical is good, not particularly because one's ideological preferences, but because things are really not working. And so I think the idea that you have to think in terms of a new international development architecture is good, as you raise it, and it's good to think very broadly, not just an architecture for the lowest income countries, but more broadly for all the developing countries, and indeed for the developed ones. So I think this is a very positive, and then I'll go into some more detail to illustrate this. And thirdly, I would like to say that I think it's also good that you are challenging the development paradigm. Indeed, it's interesting because at a previous meeting here at ODI a couple of weeks ago, we had Shruti Vadera, now Baroness Vadera, working with the South Koreans on a G20, on the G20 development work, and they are talking now of a Seoul consensus as opposed to a Washington consensus. And I think this shows, firstly, the fact that the G20 is actually different from the G8, and secondly, and perhaps more importantly, that the crisis has shown that the pure market economy doesn't work very well, and that we shouldn't impose on the poorest countries models that are not working here, particularly sort of in the sort of more extreme Anglo-Saxon model. So I think some of the elements that you give at a national level have to be, again, applauded. But in a modern sense, what is a development state in a modern sense? How do you link public and private interests and interactions? Now I'll go now into more the finance pillar, and particularly I want to focus on the compensatory financing in the face of shocks. And again, in the finance pillar, I think this report has a number of very interesting ideas, including, for example, the idea of issuing SDRs. As you know, as many of you know, the G20, in the worst moment of the crisis, agreed that the IMF should issue 250 billion SDRs. And this was extremely positive because it was a sort of counter-cyclical injection of public official liquidity when the private markets were collapsing. And it was the right thing to do. But as the report argues, not enough went to the poorest countries, only 18 billion of that. It's better than nothing, but so there are the issues of should a higher proportion of this go to developing countries, and particularly the poorest. And indeed, there are interesting steps that the French and the British have actually taken already to transfer some of these resources. Mm-hmm. And should this idea of counter-cyclical issues be institutionalized whenever there is a decline of private liquidity? And then there are more radical issues, even than what you say in your report, is should one think, as my colleagues Jose Antonio Campo and Joe Stiglitz like to do, in terms of and the Chinese more importantly even, should one revise the whole international monetary system and change it from a kind of multi-currency system based mainly on the dollar to an increasingly SDR-based system? So there is a whole open radical agenda there. So how far you go in that? And I think to the extent that there are problems of great instability of currencies, this may come to be on the agenda in an important way. Secondly, you raise interesting issues on how you deal with instability of commodity prices. One way of dealing with it is, for example, the World Bank is increasingly encouraging countries to go for private insurance against volatility of prices. But you go to a more radical solution, which is to try and curb volatility, like, for example, through taxing commodity derivatives, which I think is an interesting way of approaching it, although there will be very strong vested interests against it. And I would add an additional question, if I may, which is, should you also tax maybe the carry trade, which is so damaging for developing countries and promotes so much instability, particularly as developed countries are forced to issue a lot of liquidity, like the US just did through QE2, and a lot of these flows are not staying in the US, but are going to the emerging markets, and therefore creating asset price bubbles there, particularly exchange rate bubbles. But I want to finish by focusing on what we're working now with Dirk and with the European Commission, and what is, I think, increasingly seen as an important issue, which is the issue of how you compensate for shocks that are purely external in nature and which hit developing countries, and particularly, of course, the poorest countries. And of course, the countries that are relatively richer, like middle-income countries like Chile or Colombia, of course the Asian countries, can accumulate reserves so that they can, in good times, accumulate the reserves, and in bad times, when they're hit by a shock, can follow counter-cyclical policies with their own resources. But very poor countries can't really do that because accumulating reserves has a very high opportunity cost. And therefore, it is important for the international community to provide compensatory financing in the face of shocks. And what is interesting is that although this is an idea which actually comes from the UN and from Raoul Prebisch, really, it was taken up quite actively by the IMF in the early 60s. And in their first kind of study of it, a man called Louis Goret actually said that the key aim of compensatory financing should be to maintain the levels of imports of countries hit by external shocks. And unfortunately, the IMF has, as I briefly will explain, moved away from that principle. Now, what should be the criteria? And this is quite similar to what you say in your report, and it's drawing on the work we're doing now, for this kind of compensatory financing mechanism, which I agree with you should be integrated into some kind of architecture of shocks, as we call it with that. And the criteria should be sufficient scale. And I think the point about the scale is particularly important. It's perhaps the most important criteria because, for example, the European Commission does give valuable grants to very poor countries, but the scale of them is normally quite small, and so it's a very small part of the shock. Secondly, this facility has to be very speedy. It needs to be disbursed quickly so that it is really counter-cyclical and not arrive 3 years after the shock when it's actually pro-cyclical. And it has to be very low or no conditionality because these are external shocks. It's not the fault of the country that it's being hit by a natural disaster or by a commodity price fall. And in the case of low-income countries, there has to be a high level of concessionality, although perhaps not total concessionality. I seem to be running out of time, so I won't talk too much about the IMF facilities, but I would like to say that the IMF has actually been moving away from the concept of a more automatic, large, speedy, counter-cyclical financing, and has just actually merged, except for a very small facility, up to 50% of IMF quota, has merged shocks that come externally to problems that arise due to domestic policy mistakes. And that's exactly the wrong way to go, because then you require very high conditionality, upper credit tranche conditionality, to get financing for being funded for a shock, which is external in nature. And so therefore, this is actually very inappropriate. Although the IMF has done a lot of good things during the crisis, like issue SDRs, be more concession in its loans and so on, but on this aspect, I think the movement is actually quite perverse. This is actually in contrast with what the World Bank has done, because the World Bank has actually moved much more towards creating new crisis facilities, like the crisis response window, which emerged first as pilot and now is becoming permanent, which actually gave $1.3 billion. A lot of it has been dispersed. There's a global food crisis response facility and so on. I won't bore you with all the details. We're learning all this as we are trying to invent a new architecture. When you're trying to invent a new architecture, you have to understand the one that already exists. But I think what we need to think, and that's where I like your proposal, is to think of counter-cyclical mechanisms of a different kind that will respond to the needs of different developing countries. A sort of global integrated shocks architecture. And we have three pillars in that. One is official liquidity, which is basically what is done by the IMF. Secondly, we have official development loans, what is done by the World Bank and the regional development banks. And thirdly, we have grants, where the most coherent thing is what the EC does, the European Commission, but they at the moment only support ACP countries. So the fact that you've been a colony of a European country gives you a privilege of getting grants. So obviously that's wrong, and the good news is that they seem to be open to expand it to all developing countries. So there are a number of issues like what kind of trigger you use, but I think an important one to maybe raise here, to flag, is the issue of concessionality. Yes, grants are the best for very poor countries because they will not create future debt problems for countries that can't quickly increase their future exports. But maybe there is a case of leveraging grants through subsidizing heavily long-term development loans like IDA or European Investment Bank loans, which will at least help the country have access to sufficient resources rather than, in the face of a shock, rather than have grants but very small resources. So this is the kind of, I think, interesting trade-off and very important trade-off which we have to think of, and which of course will vary according, I think, to the category of countries. So if you're very poor, very heavily indebted, you obviously need grants. But if you're less poor, perhaps not so indebted and more flexible, perhaps you could have access to greater loans with a very strong subsidy element. Thank you very much.
Stephany, thank you very much indeed.